Hey everyone, welcome back to the channel. Before we jump into today's content, please hit that subscribe button and tap the bell so you never miss a money-saving tip. While you're at it, give this video a thumbs up and drop a comment. I read everyone and love hearing about your own tax hacks. Today we're talking about how to keep more of your hard-earned dollars by combining smart saving with savvy tax strategies. You might already know that taxes can eat into your investment returns, but with the right approach, you can actually turn tax rules to your advantage. Over the next several minutes, I'll walk you through a variety of tools, from tax-advantaged accounts like 401ks and IRAs to more advanced tactics like asset location, tax loss harvesting, and charitable giving strategies. By the end, you'll have a roadmap for building wealth more efficiently, paying less in taxes, and freeing up extra cash to reinvest or enjoy. Taxes are one of the biggest expenses most of us face, and when left unplanned, they can significantly erode the gains you worked so hard to achieve. Imagine earning a 7% return on your portfolio, but then paying 30% in taxes on those gains. That effectively cuts your return to just under 5%. Over a decade or two, that difference adds up to hundreds of thousands of dollars. The good news is, a little strategic planning up front can reduce your tax burden and boost your overall returns. The key is understanding which accounts and tactics offer the biggest tax breaks and how to structure your savings so you're paying the least amount legally possible. Whether you're just starting to save for retirement or you're a seasoned investor, these tax strategies will help you keep more of your money working for you. Let's begin with tax-advantaged retirement accounts, the cornerstone of any tax-efficient savings plan. Employer-sponsored 401k or 403b plans allow you to contribute pre-tax dollars, lowering your taxable income today. That means if you earn $70,000 per year and contribute $15,000 to your 401k, you're only taxed on $55,000. Some employers also match contributions, free money you don't want to leave behind. On the flip side, Roth 401ks let you contribute after-tax dollars, but your earnings grow tax-free, and qualified withdrawals in retirement are tax-free as well. Choosing between traditional and Roth contributions depends on whether you expect your tax rate to be higher or lower in retirement. If you anticipate a higher rate later, Roth makes sense. If you expect a lower rate, traditional may be best. Outside of employer plans, individual retirement accounts, IRAs, offer additional tax advantage space. A traditional IRA gives you a current year deduction, lowering your taxable income, while a Roth IRA uses after-tax contributions but delivers tax-free growth and withdrawals. You can contribute up to $6,000 per year or $7,000 if you're 50 or older across both types of IRAs. One powerful strategy is the Roth conversion. Moving money from a traditional IRA into a Roth and paying tax now to avoid it later. Timing conversions for years when your income dips, perhaps after a career change or during a sabbatical, can minimize the tax hit and lock in tax-free growth for decades. If you have a high-deductible health plan, HDHP, don't overlook the Health Savings Account, HSA. HSAs are triple tax advantaged. Contributions are tax deductible, earnings grow tax-free, and withdrawals for qualified medical expenses are tax-free. After age 65, withdrawals for any purpose are taxed at ordinary income rates, just like a traditional IRA. So HSAs can serve as an extra retirement account. And if you never tap the funds for medical costs, the balance can roll over indefinitely, offering a powerful way to grow savings tax efficiently. Another niche but valuable account is the 529 Education Savings Plan, which allows after-tax contributions to grow tax-free and be withdrawn tax-free for qualified education expenses, college tuition, K-12 schooling, apprenticeship programs, and even student loan repayments. Some states also offer state income tax deductions or credits for contributions. If you're saving for kids or grandkids, a 529 can shield your earnings from federal and often state taxes. Beyond account selection, asset location can have a huge impact. The idea is to place the most tax-inefficient investments, like high-income yielding bonds or real estate investment trusts, IRAs, inside tax-sheltered accounts, 401ks, IRAs, while holding tax-efficient assets like broad market ETFs or index funds in taxable accounts. Municipal bonds, which pay tax-free interest at the federal level and often state level if you live in the issuing state, are ideal for taxable accounts. This simple shuffle can reduce your annual tax bill and improve after-tax returns. A more advanced technique is tax loss harvesting, which involves selling investments that have declined in value to realize a capital loss. Those losses can offset capital gains elsewhere in your portfolio and up to $3,000 of ordinary income per year. Then you can reinvest the proceeds in a similar, but not substantially identical, security to maintain market exposure. Over time, these small tax savings compound, often paying for the cost of financial advice or software needed to implement the strategy. Just watch out for wash sale rules, which disallow the loss if you buy the same or a substantially identical security within 30 days. If you're charitably inclined, giving can also be a potent tax planning tool. Donor-advised funds, DAFs, let you bunch several years of charitable contributions into a single tax year, exceeding the standard deduction threshold while distributing donations to your favorite causes over time. You receive an immediate tax deduction for the contribution, even if the funds are granted to charities later. Additionally, you can donate appreciated securities directly to a charity, avoiding capital gains taxes you'd incur by selling them yourself. Gifting is another method to reduce your taxable estate and help loved ones. In 2025, you can gift up to $18,000 per recipient per year without affecting your lifetime gift and estate tax exemption. That means you could transfer $18,000 to each of your children or grandchildren tax-free, reducing the size of your taxable estate over time. For larger wealth transfers, you can pay tuition or medical bills directly to institutions without using your annual exclusion, further shrinking your estate. Real estate investors can leverage depreciation to shelter rental income. The IRS lets you deduct the cost of buildings, but not land, over 27.5 years for residential property and 39 years for commercial property. That non-cash expense can create a paper loss that offsets other passive income. A cost segregation study accelerates depreciation on certain components like carpeting or HVAC, front-loading deductions, and boosting cash flow early in your ownership. When you sell, you'll face depreciation recapture taxed as ordinary income up to 25%, but overall, the timing of deductions often outweighs the later tax hit. For property sales, a 1031 exchange lets you swap one investment property for another of like kind, deferring capital gains taxes indefinitely. To qualify, you must identify replacement property within 45 days and close within 180 days. This strategy keeps your money working in real estate rather than paying Uncle Sam up front. Finally, always mind capital gains tax rates in your taxable brokerage account. Long-term gains on assets held over 1 year enjoy preferential rates, 0%, 15%, or 20% depending on your income, while short-term gains are taxed as ordinary income. Whenever possible, hold investments at least a year before selling to capture the lower rates. If you foresee moving into a higher bracket, consider locking in lower rate long-term gains sooner rather than later. Of course, tax laws change frequently. What works today might shift next year, so it's worth reviewing your strategy annually and consulting with a qualified tax professional or using reputable tax software. That way, you can stay ahead of new rules, adjust your asset location, and ensure you're using every available deduction. If you found these tips helpful, please give this video a like, drop a comment with your favorite tax-saving strategy, and don't forget to subscribe for more financial literacy content. Thanks for watching, and I'll see you in the next video where we'll dive into more ways to make your money work smarter, not harder.